variable costing. There are two kinds of product costing. The first is variable costing. Secondly, is full costing. What are the differences between variable costing and full costing? How do we define the variable costing and how do we define the full costing? So, variable costing actually calculating the product costs by assigning only variable manufacturing costs. So we calculate the product costs by assigning only variable manufacturing costs. The example like this. So this is direct raw material cost, direct labor cost. Actually, direct raw material cost is variable cost, and direct labor cost is also variable cost. Why does raw material cost and direct labor cost classified as variable cost? Because raw material cost and direct labor costs change proportionately with the changes of the units produced. The more unit produced, the more raw material costs and also the more direct labor costs. So we classify as variable costs. And we add the factory overhead variable. So we get the total product cost. So this is if we calculate the product cost using the variable costing, only variable manufacturing costs. Full costing, we calculate the product costs by assigning all manufacturing costs, either fixed costs or variable costs. So actually full manufacturing costs, calculating the product costs by assigning all manufacturing costs, either variable costs and fixed costs. This is the example: direct raw material costs, direct labor costs. For example, we are using the numbers here. This is let's say 5,000. This is 3,000, and this is 2,000. So we have total cost 10,000. In this one, we have the same direct raw material costs 5,000, and this one 3,000, and factory overhead. This is also variable cost. This is variable cost, and this is variable. So 2,000, and then we add factory overhead, fixed factory overhead cost. Let's say 4,000. So the total product cost, if we are using full costing, is 14,000. So in variable costing, the factory overhead, fixed factory overhead cost, fixed factory overhead cost is treated as period cost. So not as product cost. Why we treat as period cost? So period cost will be reported to income statement, right? So we'll report it to income statement, to income statement. So why we treat as period costs? By definition, fixed costs in total remain constant, regardless the changes of the units produced, because the fixed cost is associated with the with providing the capacity, the capacity. So if we use this one, will be easier for management to make the profit planning. So this is the advantage, the advantage of variable costing to is for profit planning. For planning, because if we can have the income statement, if we are using the variable costing, this is sales, and then minus variable cost. Variable cost in this case, variable manufacturing cost and operating expenses. Operating expenses in this case consists of the marketing expenses and administrative and general expenses. So sales deducted by variable cost, so we find the contribution margin, and then we deduct by fixed costs, minus fixed costs, so we find the operating income. Income before tax. So the operating income is only influenced by sales. The more sales, the more income. Why? Because the more sales, the more variable costs. Variable costs change proportionately with the changes of the unit sold. So if the variable cost is 40%, the sales is 1 million, so the variable cost will be 400,000. If the sales is 10 million, so the variable cost will be 4 million. If the sales 50 million, so the variable cost 40% times 50 million, so it will be 20 million. So the variable cost change proportionately with the change of the activity, the sales in this case. So the more sales, the more contribution margin, while the fixed costs remain constant. So because the fixed costs remain constant, so the operating income will also increase sales, increase operating incomes. Because for example, the fixed cost depreciation expense of factory building using straight line methods. So whether we produce or not, the factory building still depreciated. Still depreciated. We cannot use full costing for the management for this purpose, for the profit planning. But this also has disadvantages. What's the advantages? It is not accordance with accounting standard, financial accounting standard. And then it's not easy to classify costs into fixed cost and variable costs. So actually the managerial objective for food costing, this is for external reporting. This costing cannot be actually it's not adequate for management purpose if the management purpose for this one profit planning. That's all our meeting for today. Thank you.